Morning and welcome back to the Money Advantage podcast. I'm Rachel Marshall and I've got Bruce Wayner here with me, my co-host that you hear us together every week on these shows. And we also have a special guest, Paul Moore, today with us as a return guest. And the previous times were a long time ago. So you maybe do not recognize this voice. I think it was 2018 last we had you on the show, but welcome to the show, Paul.
Hey, it's great to be here. Thanks for having me on.
Awesome. Thank you so much. So before I share too much about what we're going to be talking about today, I want to say, if you're in this space of saying, I want to invest well, and I'm interested in considering all of the different asset classes that I really could consider, how do I weigh them one over another? And how do I figure out, should I be in multifamily? Should I be in single family homes? Should I be in flipping properties? Should I be in cash flow rentals? Should I look at self-storage? Have you even considered self-storage? Today, we're talking with Paul Moore, and he's done considerable work in the multifamily space. And then he's really shifted his lens and his focus to the self-storage area and really been in this new way of looking at investing. So he's written multiple books, and today we are here to talk with Paul Moore about investing in self-storage in his newest book, Storing Up Profits. So before I jump in, Bruce, I know you have some thoughts that you'd like to share at the beginning and just really leading us into this conversation today.
Well, I think it's, Rachel and I, we started this podcast a long time ago for a variety of reasons, but one of the reasons that we started is to help people understand how money works. And so we tried to actually focus on this being an educational platform. So what Paul has to offer, we are not endorsing the Money Advantage, nor the state of Virginia, nor the state of Missouri, and my affiliation with E3 Wealth is not endorsing this either, or our broker dealer, Kalos Capital. This is solely for educational purposes. And if you would like to reach out to Paul directly, we would suggest you do that along with your CPA and any financial advisor that you have. Saying all that, for educational purposes, you have to really look at how real estate works in a person's portfolio. And one of the things that it does is it's non-correlated to traditional other assets that people normally invest in. And this is one of the main benefits of this, the non-correlation for the volatility purposes. And there are also many, many more tax breaks. What I believe Paul's going to talk a little bit about today is about self-storage and how self-storage actually brings in another benefit, which traditionally is recession-proof. So brings in another volatility buffer about in that specific area of real estate. We're excited for you to listen today to find out things that you thought were true that may not have been true, and other things you may be exposed to for the very first time. But this is an educational podcast today, and we hope you enjoy.
Awesome. Thank you, Bruce. And I think that was a really good lead in to the conversation today. So Paul, I'm going to turn it over to you. I know you've got a lot of experience and background in the real estate space. For somebody who has not heard of you or heard about your background before, can you kind of lead us through quickly your backstory and what you've done in real estate and where you are today?
Yeah, so I sold my company to a public firm at age 33, and I really didn't know what I wanted to do next. I thought, I'm going to be the best husband and father and friend, and we're going to move to the Blue Ridge Mountains of Virginia. And I think I became the worst version of myself, the worst husband, father, and friend, because I really wasn't fulfilling my calling, wasn't really, I was this type A, fast-paced entrepreneur in my mid-30s. And I was bored. And so I also knew that I needed to find a way to protect and grow my wealth. And so I turned to real estate. So we started flipping houses. Then we started flipping lots at Smith Mountain Lake, started building houses. And I found out something really important that everybody needs to know. If you don't know how to tighten the doorknob on your own house, you probably shouldn't build a house. I'm just saying. That's just
I remember
my
you
opinion.
saying that the last time, and that is definitely, I can relate and identify with that. So go ahead.
It's really true. And I'm in the same with self-storage, which I'll get into in a minute. But over those years, I tried to figure out, how does somebody invest in commercial real estate? How does somebody jump from residential to commercial? And I didn't know how to make the jump. Well, in 2010, we invested in an oil and gas deal that went south in North Dakota. And we actually found that there was a massive housing shortage. So we built a couple multifamily facilities, which we operated as long-term, extended stay hotels. And we made a lot of money doing that in multifamily. And then my business partner went on to build a Hyatt hotel that I was involved with. And that did not make a lot of money because oil prices shifted. But at any rate, the multifamily world just really intrigued me. So I decided to stay in that. I ended up writing a book, like you mentioned, called The Perfect Investment, humble title, as you know. And I thought, I'm going to stay in multifamily forever. But then I realized, hey, the perfect investment's not perfect if I have to overpay to get it. And I felt that, there came a time when people were paying 10, 20, 30% more than the math warranted to buy some of these assets. And we didn't want to play in that game. And so we went on a quest to find assets that were, had a lot more meat on the bone, a lot more upside. And the first one we found of several was self-storage. And so we fell in love with self-storage years ago, but we didn't have the team, the track record, or the technology to do it ourselves. So we created a fund to invest in self-storage and other asset types. And we've got 5 funds now. But that's how I got from my mid-30s to my late 50s.
That's really fascinating. And I know, Paul, that you're doing a lot of work with Bigger Pockets as well. And that has been a big part of your journey. Can you share how you're involved with Bigger Pockets and sharing on that platform?
Yeah. So after I wrote my book, somebody encouraged me to consider becoming a blogger on Bigger Pockets. And it was actually a lot easier back then to become a blogger. So I did that. And then I got involved. I just kept asking them about every 6 months, hey, is there anything else I can do to serve you? And so I was actually following, this is a little kind of a learning point, I guess, for me it was, Bill Gates. He did 3 things to become the wealthiest person in the world. Number 1, he decided at a young age what he wanted to do, and he stayed in that lane. Well, I was already messed up with the young age part. Second, he found the biggest, most influential platform in the world that would be willing to let him partner with them. And then third step is kind of, not obvious. He did everything in his power to make them successful, not himself, but them. And of course, he became the wealthiest guy in the world when IBM succeeded with his Windows operating system. So I basically took that attitude. And so they've let me do videos, they let me do live shows, they let me write a book, and they published it. It's just been a wonderful relationship for about 6 years now.
That's excellent. So is your most recent book published through Bigger Pockets?
Yes.
Oh, that's excellent. Okay. So can you walk us through what are the 40 reasons, or not all of them, clearly you can't share them all on a show, but your book starts with these 40 reasons why you love self-storage. So if somebody is considering self-storage, or maybe has not even considered self-storage up to this point, what would be some of the most compelling reasons why you found to love self-storage that they might be interested in or needing to hear?
You bet. So self-storage is unique because it's recession resistant, not recession proof, of course. And it's actually strengthened during booms. I mean, in good times, people are filling up their Walmart and their Amazon cart, and they need a place to store some of their stuff. In bad times, the people might be downsizing or relocating or shutting down their office, restaurant, or bar, like we saw in COVID, and they need a place to store their stuff. And so we found that self-storage has done pretty well in good and bad times. Another thing is the rents and revenues are inelastic. And what that means is the tenants aren't particularly price sensitive. If I had $1,000 apartment and you raise my rent 6%, I might say, rather than pay an extra $60 a month, $720 a year by signing this lease, I might move. But if I had a self-storage facility, if you had a self-storage facility, you were renting a unit to me and you raised my rent from, $100 rent by 6%, I'm probably not going to spend a weekend, rent a U-Haul, get my friends together to move all that junk. Excuse me, those treasures down the street just to save $6 a month. And so I might grumble, but I'm thinking, as soon as I get a long weekend, I'm going to clear that storage unit out anyway. Of course, that long weekend never comes and the rate increases continue to pile up. So there's a high switching cost. There's a perception of a short stay. Self-storage, more than many other assets, captures the increases brought on by inflation. If I have a warehouse or a factory that I'm leasing for 20 years, or a Dollar General store, a lot of commercial real estate, those leases are set for years or even decades. But self-storage, I can raise the rent at a self-storage facility every month. And like I said, people typically don't leave. The thing I like best, though, is the fragmented industry. Now, self-storage has about 53,000 facilities in the US. That's about the same as McDonald's, Starbucks, and Subway combined.
Oh, wow.
But
You said
about
50,000?
53,000, yeah.
Wow. Okay.
And so it's not hard to believe anymore. It used to be, but now they're popping up everywhere. And the question would be, are they overbuilt? We should answer that later. But at any rate, the industry's got this large size, but 75% are run by independent operators, and 2 out of every 3 of those independents own one facility, which classifies them as a mom and pop. Now, that doesn't mean they're poorly run, but a whole lot of them don't have the desire, the knowledge, or the resources to increase income and maximize investor value. Heck, they don't have to, because in the last 5 years, the value of their facilities has doubled just from the market demand, as cap rates have shrunk from, let's say, 9% to, let's say, 4.5%. The market has deemed that same income stream worth double. And of course, as they've increased their rents, it's increased the value even more. So a lot of them are really mediocre, and they can be acquired at, let's say, top dollar by an expert. And this expert operator can go in and do all kinds of things to extract the intrinsic value. It's also called value add, that they left on the table. And by doing that, can significantly increase the value of the property and drive investor returns. And so that's some of the things we love about self-storage.
That is very interesting. And I was going to ask you if you can comment on the idea of, if they are cropping up everywhere and you're seeing self-storage be built really on every corner, what does that mean in terms of, are there too many facilities? Are they full? And how does this relate to the idea that, as Americans, are we just hoarding? Are we too attached to our things? Are we, how do we relate to that whole ideological or philosophical idea that the stuff is maybe not as necessary, and maybe we as humans are too attached to things?
Self-storage has roughly the same demand level all across the US. There are places, really wealthy places, or places that don't have basements and attics, like Florida and Texas, that have higher demand, but it's roughly the same. Interestingly, the demand, or even the phenomena of self-storage, is virtually non-existent everywhere else in the world except Canada. And so that kind of answers your question. The subtitle of my book is it's called Storing Up Profits: Capitalize on America's Obsession with Stuff by Investing in Self-Storage.
Well, and that in itself is very interesting. Maybe it's not a good value system that we have to prioritize stuff so much, but at the same time, we're not going to necessarily convert an entire society away from that. So there is a need. There is a need based on really the desire of our society.
Yeah. So to answer your question, I'm writing an article as we speak this week called Isn't Self-Storage Overbuilt? And the answer is yes, it is overbuilt in certain locations. I can take you to Nashville and drive you all around town and show you that it is overbuilt. And I have some technical some behind the scenes stats to show you that. But I could also take you south of Nashville to a close in suburb. And there are a couple suburbs there south of Nashville that are extremely underbuilt, like Bellevue and like Belleville next door to it. Those suburbs are underbuilt. And part of the reason is the high cost of land. Part of the reason is zoning. You've got zoning people who don't want self-storage there. So it's very hyper local. That's one answer. And the second answer is there are these mom and pops that might be poorly run or just managed, in an average way, if you will, in locations that large competitors, large national companies that are building on every corner would never go. Places like Beeville, Texas, where we have 607 units in a self-storage facility there that's massively profitable. And I could, if you remind me later, I'll go back and give you a little case study on Beeville self-storage, security self-storage in Beeville, Texas. Another one, get this, Ishpeming, Michigan. Who'd ever heard of that? Well,
No.
probably about the 3,000 people who live there and the people in the surrounding area who all drive there to store their stuff in 1,500 units that we have invested in and are making a wonderful profit. So it is very hyper local.
So one of the things, Paul, if you could compare and contrast, so like multifamily value add, a lot of times they do not. I found this in our due diligence committee that I'm on. I found this very interesting that most multifamily value add type of situations, they do not want to be 100% rented for a variety of reasons. The one reason is they feel like if they're 100% rented, it probably means that the rents are undervalued. They haven't pushed the rents to where they are. The second reason is when you're not 100% rented, then your unit, when it comes available, you can actually do the value adds and upgrade those particular situations. Do you see a similar situation with like the mom and pop situations where my guess is they've been in a rocking chair, literally and figuratively, just having that cash flow come in. They're 100% rented and they haven't pushed the rents. They haven't done any value adds, so on and so forth. Is that why you maximize value so much in those mom and pop acquisitions?
Yeah, there's so many ways to maximize value. I will tell you, yes, I talked to a large self-storage facility near me recently, and they said, yep, we've been here 28 years. We've raised rents 4 times in 28 years. I found that unthinkable, but they were happy because they were 100% full and making a lot of money. And so I'll tell you, Bruce, the first time I heard value add and self-storage, I think I laughed out loud. I mean, where are the countertops and cabinets and flooring and bark park and lighting and, new appliances? None of that. We're talking about 4 pieces of sheet metal, some rivets, a floor, and a door. Yet the opportunities for self-storage value add are amazing. And I think there are actually more in self-storage than in multifamily right now for most of the deals that we look at. And I could give you an example or two if you like.
Yeah, that'd be great.
So I was thinking, can you walk through an example? And then also, if that mom and pop operator is loving their income, why in the world would they sell? And how do you acquire then that type of a unit where they're very happy already at a rate that works for you?
Yeah. So a lot of these folks are, older, they're ready to move on. Their kids, do not want to operate the business. Some of them see that, they could do a 1031 exchange out of this, let's say, $1 million facility that now has grown to 3 million. And they can, buy something else that they don't have to operate, that can throw off that, let's say, 5 or 6% income that will set them up for life. And so I think that's why, a lot of them do want to sell. Also, they're getting offers they just can't believe. And they think the people making the offers are crazy. Of course, these are experts, that are making these offers, at least in many cases. and they're going to be able to significantly augment the income and the value.
Hmm. So yeah, go
Value.
ahead and walk through some value add ideas or options that you use.
Yeah, let's go through some value add options. Here's a quick example. If you raise the rent by 10%, so about self-storage, like every other commercial real estate property, including large multifamily, is based on a value formula. The value is the net operating income divided by the cap rate. And so if you can increase the numerator and keep the denominator, if the denominator stays constant, then you should be able to significantly increase the value, and even more so increase the value of the equity, because you're using leverage in many cases. But here's a handful of value adds in self-storage. Some of them don't sound like value adds, but they do add income and value. One would be filling vacant units. Another would be by reining in delinquency. We invested in a Grand Junction, Colorado self-storage facility that had 80% occupancy. And so increasing that to the normal level of like 95 would see, that would drop the vacancy by 3/4. But more importantly, it had 80% delinquency. 80% of the people weren't paying their rent or weren't paying on time. And that's kind of typical for a mom and pop. So that's a way to increase value. Another would be add a billboard or a propane filling station or an ATM or a cell tower. Those would be some value adds. Another would be add U-Haul. You can get commissions from U-Haul, from renting out U-Hauls, for anywhere from $1,000 to $5,000 a month. Let's use our value formula to see what the value of U-Haul would be. So let's say you had a $2 million facility, you had $800,000 in equity in it and $1.2 million in debt. Well, if you added U-Haul at $3,000 a month in commission, using our value formula, that's $36,000 a year, 3,000 times 12, 36,000 divided by 0.06, which would be a conservative cap rate these days, would be, again, the value is the net operating income divided by the cap rate. So 36,000 by 0.06 would be a $600,000 increase. Wait a minute, if you only had 800,000 in equity in this and you just signed an agreement with U-Haul and got them up and running, you just increase the value of that equity by 75% just by adding U-Haul. That's a pretty good lever to pull. And so that's an example. Other things would be like adding point of sale items. Like you could set up a showroom selling locks, boxes, tape, and scissors. Another would be adding insurance and late fees. An obvious one would be reducing expenses. Another obvious one today would be taking some of that vacant land out back and converting it to RV and boat storage. Huge value add right now. And then the last one on my list would be adding some climate controlled units. A lot of these old mom and pops they don't have any climate control and they've got some vacant land with them, and you can put a beautiful, maybe 3-story facility right out front by the road, increase the look and feel of the whole place, and significantly increase your income and value because that land was already paid for.
That's fascinating. So, Paul, let's talk about what are some of the risks then? I mean, it sounds like you're talking about a lot of benefits and gains and tremendous opportunity.
Yeah.
As long as somebody knows where to look and what location to be in, we're hearing here. But what are some of the risks and maybe the downsides to self-storage?
Yeah. So the biggest risk in self-storage always happens during lease up. In fact, we got burned by this on our very first self-storage investment. We invested in a wonderful location in Bradenton, Florida, and it's one of the fastest growing planned communities in America called Lakewood Ranch. We were right in the middle of it on a main road. But 2 other national competitors popped up nearby right about the time that we invested. And so what it meant was all 3 competitors had a much slower lease up than planned. A second thing that went wrong there was those national competitors could easily undercut us on price and not feel the pain. A third thing that went wrong is honestly, they outmaneuvered and outmanaged us. They had better software, better tools. And though the company I invested with had great tools, they were still limited. They're a middle market player compared to these, multi-billion-dollar REITs that came in down the road. And so it took a long time to get leased up. And like the operator told me as I was biting my nails the second year when we still weren't seeing income, he said, I have never seen a well-located, well-marketed self-storage facility in decades not eventually get to stable occupancy. And he was right. 3.25 years into it, they sold it, and the investment paid an 80% profit to investors. And so when boiling that down over, let's say, 3.5 years, it came out to over 20% per year, which is what we had projected up front. That kind of tells you something about the market, though. Somebody was willing to pay that much more than we had in it. And we were, just getting to the point where the income was stabilized. And so it kind of tells you about the ferocity of the market right now. I've got more stories about that, but I'll bite my lip on that one. Another risk is that the seller lies to you. And sadly, we had a self-storage facility. Actually, I'll just say it was the same one. And apparently the seller significantly, very craftily and significantly inflated the income going in, because it wasn't a brand new ground up. It was already built. And 60 of the 1,000 units were, it turns out, they just went suddenly vacant right after the acquisition. And it appears that those were friends and family of the owner, or if they were real people at all. And nobody came to pick up the stuff because there wasn't any stuff. And so that was a painful hole to crawl out of as well. And again, using our math formula, that value formula can work against you just as fast as it works for you, especially when there's leverage involved. And that's what happened with that. Like I said, it turned out well. And right now they usually do. A rising tide, let's face it, raises all boats. But as Warren Buffett said, someday that tide's going to go out and we'll find out who's skinny dipping. So anyway,
that's definitely true.
Those are some of the main risks. Really, other risks would include, you invest and then the zoning changes. I know about one in somewhere in South Carolina. I'm thinking it was Greenville or Spartanburg, South Carolina. They came in and changed the zoning after the land had been acquired and all the plans were drawn up. And that's a remote possibility that's going to happen.
That's got to feel pretty rare.
Yeah. I've only heard of that happening once, but that company, which is a major national player, could not go through with their multi-million-dollar investment. I'm trying to think of other risks. Other risks would be theft. We had one that was, people, it's funny, they can go in their unit and they can actually cut a hole in the wall and get into the next unit. And what's stopping them from going through that to the next and the next and the next? And I've never seen this happen myself, but I've heard of somebody, tunneling through 10 units and stealing the most valuable stuff, because we're only talking about sheet metal. So it's pretty easy to get through. So it's really important to have security, which is sometimes another difference between a well-run facility and a mom and pop.
You can definitely see how that would be an extremely valuable thing to have, knowing that you have the security and maybe even be willing to pay a little bit more for that if you're the customer.
Right. Yeah.
So Paul, it sounds like you're advocating two things. I don't know if you do build up, like creating from scratch, building from the ground up, as well as purchasing units that are already in operation and purchasing those and doing the value add. Do you do both, or do you just purchase currently run facilities?
We generally acquire currently run facilities. However, we're open to doing ground up and reconversions. There's basically 4 paths to success in self-storage. Number 1 would be ground up development. It's by far the highest risk and the highest potential return. Right behind it would be a reconversion, or a conversion, I should say, of an existing building, or a retrofit. My friend AJ Osborne actually bought the Reno Kmart, the Reno, Nevada Super Kmart. He had, after selling off the parking lot to apartment developers, he had $7.5 million in it. That was $2.5 million cash and $5 million in debt. He cut it in half, turned it into a beautiful self-storage facility, leased it up. And on the way to lease up, I was on the phone with him in 2018, and he got an offer of $26 million on that property. He turned it down because he believes by adding more storage, adding a second floor, he can actually get it to $50 million. And so he is crushing it with that retrofit or that conversion, whatever you want to call it. A third path would be buying a stabilized facility, just buying like a REIT would, just something that's already stabilized. That's not going to be appealing to many of us, if any of us. And then the fourth path would be my favorite, which is the value add or the intrinsic value play that we've been talking about on this show.
So, Paul, if somebody is really interested now after hearing about the benefits and the success that you've had in this space, what if they don't have 3 million or 10 million to invest in a self-storage facility? What options are there for getting involved in this space?
Yeah, so the last third of my book has 7 paths to success in self-storage, and this is a lot of these, options are, not options that most of us would do, but that would include getting a job at a self-storage facility and working your way, growing your knowledge, working your way into the business. It could also be getting a job as a broker or a lender or an asset manager, lots of things like that. So that's one path. Another is starting small, getting a really small facility, learning the ropes, renting it out, fixing it up, and then moving on to a larger facility. Some people call that stacking or stair stepping. Another would be joining a company as a capital raiser. If you've got lots of ability and skill in sales and social media and you want to raise capital for other people's deals, you can do that as long as you do it legally. Another one would be being a deal finder, and that would be finding deals and plugging those deals into a larger company and then just keeping a piece of ownership. Another would be getting a paid coach or mentor and learning the business from this mentor, and then potentially finding a partner or partners, including that mentor, and then partnering with them on future deals. The last path in my book is my favorite, and that is, of course, investing passively. And if you've got a busy job, a busy life, or enjoying your retirement, and you want to be part of this, but you don't want to get your hands dirty and do it all yourself, you can find a great syndicator or fund and invest with them and let them do the heavy lifting, and you enjoy the income, appreciation, and tax benefits.
Oh, I'm glad you said that, because that was going to be my next question. If that we're not offering tax advice, but what are some of the tax benefits that a person would enjoy in this situation?
Yeah, so like on any real estate, we've got the possibility of doing a 1031 exchange, and that is certainly an option with self-storage. Another would be the fact that as a direct investor, getting a K1 rather than a 1099 from the company, you're enjoying the depreciation losses. Those depreciation losses are paper losses, and they're accessed typically by doing a cost segregation study. So if you have a commercial property, you can do this cost seg study that allows you to put a lot of the costs of that facility into shorter time buckets. If this makes no sense to you, then you probably have to go look it up. But just to keep this kind of short, for the listeners that do know what I mean, instead of depreciating it over 39 years or 27 and a half years, a lot of these components of the property can be depreciated over, say, 15, 10, 7, 5, and all those, thanks to the tax law that was passed in 2017, can be depreciated now in 1 year through bonus depreciation. It's a way to create massive paper losses and tremendous tax benefits for investors.
And what's interesting about that, Paul, is especially now that we're in an inflationary type environment, money today is worth more than it's going to be in the future. So anytime you can get those bonus depreciations or shorter those shorter schedules for depreciation, that means that's more money put into your pocket today that you can reinvest, or spend, or frankly give it away if that's what your heart wants to do. So that is a very, very strong reason to do this. When you're looking at tax benefits, I like to always tell our people, especially when you hear people talk about loopholes, these are not loopholes. Loopholes always has a negative connotation, and many people will actually use loopholes for legitimate tax deductions in the tax code. But these are incentives that the IRS, through Congress, passing laws that are trying to help people get what they get. And if they get what they get, then Congress gets what they want. And that is actually reinvestment into our United States economy. And
Right.
so I'm a big proponent of this. I'm trying to get the word loophole out of the American vernacular, because when I hear people say that, they really don't understand how the tax code works.
No, he's absolutely right, Bruce. And I agree with your point about inflation as well. But yeah, these are not loopholes. These are what they want. They want people to build self-storage facilities and mobile home parks and boat docks and apartments. I mean, there's a huge housing shortage in the US, and apartments. And a lot of these type of things are, they're incentivized. And I really wish the bonus depreciation wasn't phasing out over the next 6 years, but unfortunately it's going back to normal. But even normal is really good. I mean, there's a lot of paper losses created through commercial real estate.
I think that when you look at the whole picture, it's really important to understand all of the benefits that you get by making decisions that might seem like they're alternative, or they're not what everyone on the street is doing. And sometimes you find the best opportunities by looking where everyone else is not looking. So Paul, that's one of the reasons why I love being able to talk about things like this on the show. If somebody does want to reach out to you, I believe they need to be an accredited investor to work with you. Can you talk briefly about that, and then share with our listeners how they can get your book?
Yeah. So yeah, if they want to reach out to us, I spent years, like I mentioned at the beginning of the show, trying to figure out how to get into commercial real estate. So I've created a simple guide, which is an introduction to commercial real estate investing. And then I've also got other guides, including introduction to self-storage, mobile home parks, etc. You can get that at Wellings Capital, WELLINGS, wellingscapital.com/resources. Anybody can get that information free. If you want to invest with us, like you said, you need to be an accredited investor. The SEC has set up those rules, and we need to follow those rules, and we do very carefully. As far as getting the book, you can get the book at biggerpockets.com/storage. And the reason to go there is there's lots of bonus materials you don't get when you buy the book anywhere else. It's also available at Barnes & Noble online and Amazon as well.
That's fantastic. Now, Paul, before we let you go, I know we've talked about this on previous shows as well, but you have a kind of a higher purpose that you do a lot of your work for, and you're very focused on generating funding to fight human trafficking. Can you share kind of why that is so valuable to you? I mean, certainly that's a cause that I believe, I mean, I'm interested in, and not as vested as I would like to be in fixing that or solving it. But how do you use your business to fund the causes that you care about so much?
Yeah. So if you took the why first, if you took the record profits, not the average, the record profits of Apple, General Motors, Nike, and Starbucks, put those together and doubled that number, that's the approximate profits generated by human trafficking right now every year, according to the US State Department. And I'd like to believe, if I was alive in the 1800s, or if I was an adult in the 1960s, I'd be fighting against slavery and for civil rights. Well, this is a civil right, and it is slavery, and it's happening right under our noses, right in our time. It's the largest number of slaves ever in history are right now. In fact, It's estimated that approximately 400 people have been captured or sold into slavery since we started recording this broadcast. And so it's quite troubling, and I want to do something about it. So our company is making an effort to go forward to vet. One thing we do in our commercial real estate business is we vet the very best operators and we put those into our funds. Well, in this arena, we're vetting the very most effective nonprofits, and we are doing a lot of background due diligence, et cetera, on them. And then we're recommending people invest to free slaves. On Giving Tuesday, right after Thanksgiving, we put in an email, we put out a match from our company, and we were able to raise $65,000, which was enough money to free 65 slaves in Cambodia through the organization that we're working with.
Wow. So that is a powerful way to say you're not just using your own profit to be able to make this happen, but you're involving your investors in being able to reach these bigger goals. I love that.
Right. Yeah, that's right.
So, Paul, something else that we'll probably leave till next conversation with you, just because of the time that we need to take to wrap up today. I just want to thank you for being with us on the show. I thank you for continuing to do good work and being able to educate investors and help people, not just yourself, to profit and thrive in this investing space, but you're bringing along other people with you, and you're providing that coaching and the resources and the guidance and the content, the books, the materials for people to step into that space and say, how do I become educated? How do I learn more? And how do I step into this position of creating this cash flow and investing in real estate, maybe in a different way than I've thought of before? So thank you so much for doing that work and for coming on our show to talk about it.
Thank you. Well, Rachel and Bruce, it's a real honor to be here again. And I really appreciate both of you. And I'm so glad to be here.
Awesome. Awesome. Well, thank you so much, Paul, for being with us on the show today. You heard Paul say, go to wellingscapital.com/resources to get those guides for getting started in investing. Anyone can do that. And so I would encourage you to go ahead and get those guides. Thank you so much for listening on this show today. And the one next step that you can take with any information that's educational is to say, let me consider more. Let me become more educated. If this had sparked your interest or your capability, your concept of what is capable and possible for you, dig into learning more to find out if it would be a good fit. So thank you so much for listening. And in closing, please remember, success leaves clues. So model the successful few, not the crowd, and build a life and business you love.